Hello, and welcome to another episode of Money Ministry. I'm your host, Craig Mack, and we're going to continue with our series on technical analysis. If you're new to the channel, welcome. Uh, this channel is about learning how to invest in the stock market. I go over the basics, and right now we're doing a series on the technical indicators, how to set up your technical indicators on your brokerage account. Uh, if you haven't already, please go through the playlist from the very beginning because that way, the content that I'm presenting today will make more sense to you. Each episode that I do builds on the previous one. So we're still on the subject of technical analysis and the tools that you'll need to use to interpret the market and or stocks. So that's what we're doing right now. And if you've been with me from the very beginning, thank you for hanging with me. And with that, I'm going to start out by establishing my credibility for the new folks. So folks that have been with me for a while, please just bear with me. As you can see, this is the S&P, but that's not what I want right now. What I want is portfolio performance. Okay. All right. Portfolio performance. So year to date, as you can see here, I'm at a negative 1.26 return. Given all the turmoil with the war, the fake war, the Epstein war, whatever you want to call it, just like everybody else, it's caused the market to go down, which means my portfolio went down. However, what I want to point out is that even though I lost 1.26% on my portfolio, I'm still doing better than what was lost on the S&P and the NASDAQ combined. Okay, I only lost 1%. They lost 7 on the S&P and 10 plus on the NASDAQ. Now, for year to date, since January, I'm down $561.82. And some of you will probably are wondering, well, what's my portfolio comprised of? I don't share my portfolio because I'm here to educate and to teach, and I'm not here to give you stock advice. So this is a good segue into me handling the legal ease here. This information is for educational purposes only. I am not a financial advisor. I'm not licensed to be one. I strongly recommend that you do your own research. You do your own research or you consult with a financial advisor before making your stock selections. Okay, now that I got that out of the way, year to date, like I said, I've lost $561.82 so far this year. Over a 3 month period, I've lost 632.81. I got a negative 1.64%. And then maximum since I've had my brokerage account, I'm up $22,147 since November of 23. And I have a return of 152.81. Okay. Also, just to show you that I'm in the trenches in here with you, I keep a daily tab on my profit and loss for the day. And so today, with the market going up, I was able to have a gain of $1,329.05. Okay. I'm still down for the month. I still took a loss of 933.28, and I had an average loss of $42.42. So today's rebound really helped me out a little bit. Still didn't make me positive, but it's not as bad as it was. As you can see, prior to that, I was down 2,262.33. So I did make up some ground. So that's good. Hopefully, April will be a better month for me. Okay, so now let's get into the market. And let me just switch this and then I'll come back to it. Switch that to the S&P. And then I'm going to go here and then I'm going to present here. We're going to talk about the slow and fast stochastic. I always struggle with that. Understanding and comparing momentum tools. So it is a momentum tool. Your stochastic is a momentum tool. Uh, let's go. Next slide here. What is it? It's an oscillator. Okay, it was developed by George C. Lane in the late 50s, 1950s, that is. And basically, it keeps track of the relative price range over a 14-day period. It oscillates between 0 and 100, signals overbought when the oscillator is above 80, oversold when the oscillator is at 20 or below, and it tracks the momentum changes before the price does. Okay? All right, next slide. For those of you that are into crunching numbers, here's the formula for the fast stochastic indicator. The pros is timely, gives you early heads up to entry points and exit points, ideal for short-term traders. So those of you that are interested in going into options trading, you might want to set up your indicator on your platform to use the fast stochastic as opposed to the slow stochastic, okay? It keeps track of quick market changes. Cons, more prone to false signals, susceptible to market whipsaws, and requires full confirmation. Next slide. Now, the slow stochastic, which is the one that I use, is more for long-term traders or swing traders, okay? And for those of you that are into math, there you go. There's the formula. But it's less sensitive. It has smoother lines, producing fewer but more reliable signals, trend indicators than the fast stochastic. 14 days is usually the setup. 14-day periods of factor of 3 for enhanced accuracy. All right. Visual comparison. This is what your fast stochastic would typically look like. You can see a lot of peaks and valleys, very choppy. And then your slow stochastic is smoothed out. It's much smoother lines, okay? All right. Now to interpret it, anything above 80 is considered overbought. And that means that there's more downward risk, okay? More downward risk. And what I mean by that, more chance the selling is going to start taking place when the stochastic gets above 80, okay? Bear signal. If the K crosses the D in a downward momentum, that is a sell signal. Oversold. If the oscillator is below 20, that's a potential buying opportunity. This means there's more room for the upside to take place. And if the line crosses, these are your signal lines in your stochastic, the K and D. If that line crosses, the K line crosses the D line, upward momentum, that represents a buying opportunity. So let's go to charts here. I can pull it up for you. Down here is my stochastic. And as you can see, this is the S&P 500. S&P 500 is oversold. It's in oversold territory. But here's what we're talking about. Your gold line is your signal line, and your trend line is your blue line. It has crossed the signal line in an upward trend. So that means that there could be a bullish signal, right? Bullish signal, all right? Now, let's combine that with our MACDs here. And remember, we told the red bars mean negative momentum, but they're starting to get smaller, which means that it's moving towards positive momentum. And then you got your MACD line, your signal line. It hasn't crossed yet, but like we saw on the slide there, this is an early indicator. Your stochastic is giving you a heads up that, hey, they may be starting to buy here. Now, we combine that with our candlesticks here, right? Large candlesticks means institutional buying is taking place. So that's why you had such a big move today, right? The market was up what? S&P was up 184 points. So that's why you had a big move today. Big move like that in the S&P doesn't happen without the big dogs getting involved in the market and starting to put cash to work. So that's what that means. And that's what the charts are telling you. These are the two charts. We went over the MACD and we're going over the Stochastic now. And this is how you use them together along with your candlesticks and along with your exponential moving averages up here in your charts. You put that all together and you're able to then start interpreting the market or the stock depending on what you're looking at. Okay, so let's move on. Fast stochastic. All right, again, same thing. If it's below 20, there's a potential upward reversal. And then if it's above 80, that means that there's potential for downward pressure. Same thing with the slows. We just went over that. So I'm not going to bleed the slides. And by the way, for those of you that are new, um, I use this style of format by putting the information in decks so that you can learn at your own pace. I tend not to read the slides. I'm assuming that you're able to read. And so I just try to summarize them. You can always go back and stop the video to read and to make sure that you get this information, take notes, screenshots, whatever is best way for you to learn. But that is why I put it in this format so that you can learn. Because main thing is I want you to learn how to interpret the charts. I want you to learn how to be better traders. Or at least get off to a good start. I know this is a tough market, but we're going to get through it. I think things may be starting to turn around. Okay. All right. So next slide. So summary, choose between the fast and the slow. Now, if you're an options trader, then or a short-term trader, then you probably want to set your platform up on your brokerage account and use the fast stochastic. If you are a long-term investor, then you probably want to go with the slow stochastic. Okay. And here's the reasons why. All right. Last slide. Mastering momentum. So the stochastics, they're a momentum predictor, gives you a visual analysis, and it helps you with your strategic timing, whether or not to go, whether you want to use it as an entry point or an exit point, timing decisions. Okay. That's what it helps you to help you as a tool to help you make that kind of decision. All right. So I'm going to stop sharing now. All right. So now I'm back. So, the market is starting to show some signs things may be starting to turn around. I know it was a rough month, but, we'll see what happens with Trump. He's starting to signal he's looking for a way to get out of this war, understands that he made a huge mistake. And the markets are trying to nudge him in that direction by responding to the rumors that he's, told some aides that he's looking to, he's willing to back off, even though they don't open up the strait over there. So we'll see if some kind of resolution comes, but the market is basically trying to show him he needs to come up with some kind of resolution for this and put this one to bed. So with that, keep the faith, hang in there. For those of you who are already trade investors and have a portfolio, hopefully you did not sell because you would have missed this move up that just took place. This is a learning opportunity. And for you new investors, this is a learning opportunity. Once you establish your portfolio and you get it in order, when things like this happen, if at all possible, don't sell. I know it looks bad. All that red every day is negative, bad, negative. You see yourself losing money. But just keep in mind, it is only a loss if you sell. If you don't sell and you hang on and the market rebounds like it did today, then you haven't lost anything. Okay. And if you're just starting out, as you get more experienced and more mature in your investment journey, you will recognize that if you had cash, sitting on the side with some cash and was looking to get into the market, this is probably a good time to get in. All right, because everything was on sale, everything was at low prices, and they're going to start climbing back up. So if you get in now, then you can climb back up with them. Okay, and then you'll come out ahead, huge. You'll make a huge gain right now because I think if there's a follow through tomorrow, the market's going to be up again as long as the orange man doesn't say something stupid. Uh, Tomorrow to rock the markets again. But if he doesn't and things, stay as they were today, you're going to see the market go up some more. So, but be careful about it. All right. Start out slow. Remember, pay yourself first. That's how you have the cash available to get involved and participate in this market. That's what I preached from the very beginning. You go back to my earlier videos. That is what makes this system work for you. You have to pay yourself first. Don't put yourself last. Don't pay all your bills first. Pay yourself first and then pay your bills. That's how this works. And then that way you can invest that money that you save, $25 in your savings account, $25 in your brokerage account. You can start off small until you get more comfortable and let that system work for you. And you will succeed. You will be successful. Okay. So hopefully you've gotten some out of this. Hit the like and subscribe button, please. And also, I'd like to hear from you. You can put some in the comments. You hate this video, you like it. That's okay. I got thick skin. I can take it. But I'm looking to get some feedback from you and get your thoughts and interact with you. So I will look at them and I will respond. Okay. All right. So with that, I'll let you go for now with this session, and I will see you on the next one. Take care.